Welcome, and thank you for tuning in to ESG Talks, a KBRA podcast series focusing on environmental, social, and governance (ESG). This podcast series highlights various ESG hot topics and includes commentary from prominent voices within the ESG community. In this episode, I speak with Peter Giacone, Senior Managing Director and Global Head of KBRA's Insurance Group. Peter and I discuss a recent insurance headline. One of the largest home insurers in the U.S., State Farm, will stop offering new coverage in California because of increased catastrophe exposure. This news highlights one of the potential impacts of increasingly severe weather events within the insurance sector. Peter provides insight into the sector's position within the larger climate change conversation and also shares his perspective about possible longer-term trends. Thanks for coming on, Peter. So many of our listeners likely saw the recent New York Times article, "Climate Shocks Are Making Parts of America Uninsurable. It Just Got Worse," highlighting State Farm's decision to stop offering homeowner insurance coverage in California due to, quote, rapidly growing catastrophe exposure. Before we get into that in more detail, I want to take a step back and I'd like to get your insight into the role that the insurance market plays in ESG and more specifically climate change.
Thanks, Emily. It's good to be here today. Just to set the stage a little bit, when we think about the insurance industry, insurance companies in general are a very major player in the world of ESG in a lot of different ways. And the reason for that is that insurance companies, as you know, provide a mechanism for transferring risk from one party to another. If you look at the various pillars of ESG, there is a wide range of risks, and insurance companies, in very broad terms, are key players within those various pillars. In some senses, there are some very obvious connections. If you think back to the history of the insurance industry providing property coverage policy, homeowners policies on both residential and commercial properties, very obvious connection there and a very obvious source of risk transfer. There are some other areas within the world of ESG, such as cybersecurity, where insurance companies have become more recent entrants into that market by providing coverage to ensure companies are protected against the risk of a cyber attack and the various knock-on costs and consequences of those types of events, and in order to protect companies as they move forward in their various operations. But the thing to keep in mind is when insurance companies are pricing for those types of coverages, they're doing that pricing based on a very intense analysis of historical trends and data. And what they're trying to do is to predict outcomes and look at a range of outcomes and assign probabilities to those various outcomes in a manner that allows them over time to earn a reasonable rate of return in order to build surplus, protect their financial position, and most importantly, to be there in the future to pay those claims. Now, the second piece of this is that when they're pricing those policies and providing that market intelligence, if you will, out there to those looking to protect themselves from the various risks, that's signaling to the market things that companies and individuals can do to also mitigate the risk. So if you think about building codes, for example, in the state of Florida, it's a great example of what happens when insurance companies are pricing policies. If they get to a point where the policies cannot be profitable, they may actually withdraw. And that's exactly what happened in Florida after the series of hurricanes over the last several decades. What's happened in the interim is the government within the state of Florida took very decisive action to force and revise its building codes in order to make buildings more resilient to hurricanes and wind exposure. The outcome of that, if we look at the most recent hurricanes over the last couple of years, Hurricane Ian most recently at the end of last year, there's been a lot of research shown that the houses that were subject to those new building codes and were built most recently based on those updated codes fared much better and had much less damage. That's a win-win for the homeowner, and it's a win-win for the insurance companies as well. So the key message here is that insurance companies provide a very good early warning system for policymakers and the market as a whole in terms of looking at risks to the extent that they have difficulty pricing those risks, that allows the market to adjust and to put in place other risk mitigation techniques that make those risks something that insurance companies can come back and insure over the long term. The second area of ESG where insurance companies play a big role is they control large pools of assets. And based on any sort of identified stakeholder preferences with respect to supporting carbon transition, things of that nature, to the extent that insurance companies are aware of those preferences or may even have some of those preferences in terms of their own mission and strategy, they can actually steer capital towards those types of initiatives and make a real change and certainly foster significant change within that to the extent that insurance companies can steer assets and capital into specific initiatives, they can actually affect change in a very positive way. Finally, what I would mention is that when we look at some of the larger insurance companies in the United States, and if you talk about, for example, State Farm's announcements we're going to talk about here, it's a very visible corporate citizen. And so their actions are noted by the market in general. And so when they make an announcement and take a large corporate action, such as exiting a market as large as California, the market will stand up and take notice of that and will likely result, in my opinion, in future changes in that market that in the long run may be better for policyholders.
I think that's very helpful. And it might be also helpful for our listeners to understand how we think about climate change in our credit ratings of insurance and reinsurance companies at KBRA. Can you walk us through that?
Absolutely. And consistent with the way our firm looks at ESG more generally, it's always in the context of management. So, just like the rest of KBRA, we don't assign any arbitrary scores. We only look at ESG considerations as they specifically pertain to credit. And for insurance companies specifically, this is really focused on financial strength. And as I mentioned earlier, the ability of of an insurance company to fulfill its obligations to policyholders. So the kinds of questions that we're asking our rated companies are, how are their insured, their policyholders transitioning to a lower carbon footprint? To what extent are they taking this into account in their product offerings? Does your company, when we're doing our management diligence as a part of the rating process, do you assess the accuracy of internal and external models in order to assess risks? There's been a tremendous amount of development, and the acceleration of the technology and the ability to capture data has put insurance companies in a much better position than they were even as recently as 4 or 5 years ago in terms of the ability to quantify and assess risk, including climate change. And so, key consideration for us at KBRA is to make sure that insurance companies are trying to look around those corners and incorporate and recognizing the limitations of the models we have and looking for ways to enhance them so that they can ultimately improve their pricing, as I alluded to earlier.
So now that we've kind of set the stage, with the increasingly severe effects of climate change, how is this affecting access to insurance? As we mentioned, State Farm has pulled out of California. Allstate has also stopped offering new coverage in the state. Is this part of a broader trend?
Actually, insurance companies moving in and out of lines of business is not a new concept. What you have here is a situation where it's a very large company in a very large state. It's a very public move, and so it's getting a lot of media and public attention, which is a good thing. But having said that, insurance companies in general cannot survive and flourish unless they can consistently charge enough premium to adequately cover the risks that they're insuring. There's a natural volatility in results. No one can predict the future with absolute certainty, and this sort of uncertainty and known level of volatility has historically always been built into the way insurance companies price risk. There'll be years when insurance companies make a fairly good return and earn a good amount of profit above what they're collecting, and the amount of loss. There are years when the amount of premium collected is actually greater than the amount of claims that the company experiences. And then in the alternatives, and there are other years when the amount of claims that insurance companies pay out are higher than the amount of premium that they've actually collected. And so that natural ebb and flow in terms of the amount of money that's charged for a particular risk versus the claims that actually come in, to the extent that that number continues to go up and down, that's sort of an embedded part of the insurance process. But to the extent that it's consistently the case that the amount charged is not enough to cover the claims, that's a problem, because over time it's going to erode financial strength and prevent those companies from being there to pay policyholder claims over the long term. Many of these policies are short term, they're 1 year policies, sometimes shorter. But that being the case, the insurance companies need to keep up with the evolution of the risk. And if they can't do that in a sufficient fashion and constantly chasing their tail effectively, then they're going to be in a situation where ultimately their financial strength is going to be negatively impaired. If you think back again to the example of Florida earlier, I think it's a great example of what's happened in terms of the environment not being conducive to insurance companies earning at least enough to cover their cost of capital. And so what we've seen in Florida is changes on the legislative front to make the claims experience more predictable by eliminating one-way attorney fees and a couple of other changes that were made at the end of last year in the Florida legislature. And that's positioned things well. And as a consequence, capital has started to flow back into that market, and homeowners coverage is, while more expensive than they were historically, are now increasingly available. And that's a win-win for consumers, and that's a win-win for the industry.
Great. So, Will insurance still be available as the effects of climate change continue to strengthen in many areas of the US? And what are some possible solutions?
Well, clearly, as I've noted, there's a tremendous amount of back and forth between risk mitigation and pricing. For example, if you want to build on the coast these days, you better build your house pretty high off the sea level. You better be on stilts or at least be 8 to 10 feet or whatever the building code may require. But you can't just build right on the beach the way you may have 20 or 30 years ago. And so there's been a lot of change in terms of how the market reacts to those things, and all of that goes back to the feedback and the early warnings and the insurance industry and the signals the insurance industry is providing to the market as a whole. But if the insurance companies can't be sort of the single solution here, it has to be a combination of public policy changes, government stepping up, and working collaboratively with the public in order to put the industry and put the market in a position where economic activity can continue to occur, but at the same time be done in a way that's prudent and in a way that mitigates the risk, in a way that insurance companies can provide real value add to their policyholders.
So, the last thing I want to ask you is that you're going to be moderating an upcoming panel at the Bermuda Climate Summit that KBRA is co hosting with the Bermuda Development Agency. And your panel is actually in a similar topic vein as the one we've discussed today, which is the role of the reinsurance sector in the US federal flood program. So, flooding is the most common natural disaster in the US, but historically, the private reinsurance market has played a limited role in flood coverage. Any teasers you can offer for the upcoming panel?
Absolutely. Well, the timing of this panel is quite good. Earlier this month, or about the first week of June, the National Flood Conference was held in DC. There was over 1,000 participants in that. And flood coverage is something that is receiving an increasing amount of focus in the media, and with good reason. Flooding, even though hurricanes tend to get the headlines, flooding is actually the most common natural disaster that occurs in the United States. All 50 states in the Union can report. Every single state, no matter where you live, has been subject to floods for any of a host of reasons. Climate change clearly being one of the causes that needs to be considered. And the National Flood Program has been around for decades, but up to this point has provided probably only a limited amount of coverage that's really been able to mitigate that risk and to provide sufficient coverage to policyholders going forward. The policies historically have been fairly limited, and the pricing of late has actually been going up quite dramatically in order to match that up. So there needs to be sort of a reckoning, if you will, in terms of how the public sector and the private sector are going to be able to work together to get this program in a better position in order to protect the general public and those who are in flood exposed areas, get them the protection they need at a cost that they can afford. So again, a lot of public attention on this. We have a panel of experts who've both worked at FEMA as well as the brokerage community and some other public policy folks who have had a lot of experience in this area. And we're going to be talking to them about some possible solutions and ways to address this going forward so that flood coverage in the United States can be something that is more readily available and priced appropriately to continue the program going forward.
Thanks very much, Peter, for coming on today. And we'll look forward to hearing more on the role of insurance in climate events with your upcoming panel at the Bermuda Climate Summit. This concludes our episode. Please email esg@kbra.com with any questions or comments. We also encourage you to visit KBRA's ESG website at esg.kbra.com, where you can find research related to the topics discussed in this episode, further details on KBRA's ESG approach, and other ESG-related media items. You can also join our mailing list to access our ESG Weekly Roundup newsletter.